didn't start like a trade dispute. It felt more like a trap. In a single night, Beijing cut the cord on America's manufacturing heart, halting the flow of lithium and battery materials that keep everything alive, from Ford's electric trucks to the Pentagon's high-tech drones. At 3 a.m., Treasury Secretary Scott Bessent sent a chilling alert to the White House. "We'll be out of stock by Friday." Within hours, Detroit's assembly lines froze, market futures tanked, and Trump's promise of self-reliance collapsed before the cameras. China hadn't fired back. It had simply flipped the switch. Publicly, Trump brushed it off as empty retaliation. Privately, his aides called it what it was: uncharted ground. For decades, Washington's entire supply chain leaned on Beijing for over 80% of its battery materials. A fact confirmed by the International Energy Agency in its 2024 report. The tariffs were meant to break that grip, but instead they ran straight into a bottleneck. China had quietly engineered years earlier through its dominance in global mining, refining, and midstream processing. The markets didn't wait to react. Commodity indexes spiked almost 3% overnight, and lithium carbonate shot up to $12,000 a ton. Goldman Sachs analysts, quoted by the Financial Times, warned that Western suppliers couldn't catch up before 2028. Yet Trump doubled down, claiming America had alternatives. But government data told another story. In 2024, the U.S. produced barely 1% of the world's rare earths, and none of the battery-grade manganese it desperately needs despite billions poured in through the Inflation Reduction Act. Projects in Nevada and North Carolina are still stuck in testing, and Reuters says Thacker Pass won't start full lithium production until 2027. That means companies like Ford, GM, and Tesla are dangerously exposed. 2/3 of their electric models rely on Chinese materials. Meanwhile, Chinese customs data from September 2025 showed a 31% collapse in rare earth exports, the sharpest drop since 2019. Reuters traced it to new licensing rules for magnet makers in Inner Mongolia. The same magnets used in F-35 fighter jets, turbines, and heavy-duty EVs. Those components were once called vital to national security. Now, they're doled out at Beijing's convenience. Inside the Pentagon, the situation was just as tense. Procurement officers warned that defense contractors had less than half a year's supply of key magnetic metals left. An internal memo from the Defense Logistics Agency, obtained by the Wall Street Journal, called the shortage manageable through 2026. But only if allocations stayed steady. They didn't. Then came the hit to U.S. farmers. Soybean prices cratered as China completely cut out American suppliers, importing nearly 13 million tons from Brazil and Argentina instead. For the first time since 2008, USDA data showed zero pending soybean sales to China. That single move wiped out more than $3 billion in farm income within weeks. Farmers called it déjà vu, a repeat of the 2018-2019 trade war, when Washington had to issue $28 billion in emergency aid. This time, the Farm Bureau estimates the cost could top $35 billion, thanks to inflation and soaring interest rates above 7%. The Federal Reserve's 2025 review shows those loan costs now eat up 7% of all farm expenses, the highest burden in 2 decades. This wasn't how things were supposed to play out. In Trump's second term, tariffs were meant to bring factories back home. But that plan depended on materials still controlled by China. In April 2025, Reuters reported Beijing had widened export restrictions to include 7 heavy rare earths, the kind used in advanced magnets and laser-guided systems. The White House called it a sign of Chinese panic. But if China's the one panicking, why are investors rushing to Shanghai instead of New York? Because this was never random. It was part of a long-term play. Back in 2023, China's Ministry of Industry quietly reclassified magnet manufacturers as national security assets. By 2025, those same firms dominated 90% of global supply. The Financial Times called it a policy lever on par with the dollar. That phrase stuck. On par with the dollar. Trump's counterpunch, a proposed 100% tariff on Chinese imports, sounded bold but came with a heavy cost. Analysts at the Peterson Institute calculated it would push EV prices up by $11,000 each and crush demand by nearly 40%. Economic patriotism, as one senator called it, was starting to look like a tax on consumers instead of a boost for workers. Meanwhile, China played the long game. By squeezing the raw materials market, it pushed foreign automakers to move their production inside China's borders. BYD, already the world's largest EV producer, delivered 580,000 vehicles in the third quarter of 2025, surpassing Tesla's 500,000. Reuters revealed that BYD's new factories in Brazil and Thailand are fed entirely by Chinese-made cathodes, dodging Western tariffs altogether. So these restrictions weren't retaliation. They were consolidation. China turning the world's supply chains into its own chessboard. Trump calls it cheating. Economists at the IMF call it industrial hedging. using control over production bottlenecks to manage global prices. But no matter what label you use, the outcome is the same. The West pays more, and Beijing gains more leverage. Across Europe, the panic is spreading. The EU's Trade Commission warned in October 2025 that China's export curbs could cripple half of Europe's defense and semiconductor output. And that's the real takeaway. This isn't just a US-China confrontation anymore. It's a global struggle over who controls the materials that shape the future. And inside Washington, the cracks are starting to show. Inside Washington, the message is divided. The Treasury urges calm talks, hoping diplomacy can slow the storm, while the Commerce Department argues that pressure might bring results faster. Over at the Pentagon, the concern isn't about headlines or tariffs. It's about resources. As one defense official quietly put it to the Wall Street Journal, "You can print as much money as you want, but not the metals we need." On Wall Street, investors hold their breath as the yuan barely moves, even with new US tariff threats making noise. According to Bloomberg's currency analysts, China's secret might be its gold-based payment network, a system that routes export earnings through Shanghai, in either yuan or gold. This keeps Chinese trade protected from American sanctions and gives Beijing a new kind of leverage, one based on minerals instead of money. The White House tries to dismiss it all as market rumors, but the facts don't agree. Car giants like Volkswagen, Hyundai, and Toyota are already reporting delays of 6 to 8 months for key battery shipments. Japan's Auto Industry Association even admits, politely, that global supply chains for critical minerals now lean heavily toward Chinese control. It's diplomatic language for, "we're dependent." Meanwhile, Trump's political options are tightening. With elections drawing closer and farmers demanding help, the administration moves to roll out a fresh $32 billion bailout plan, modeled after the 2019 farm rescue. But this time the math is worse. Borrowing costs are double what they used to be, and the Congressional Budget Office expects the federal deficit to balloon to $2.4 trillion by 2026. The reasons? Tariff bailouts, defense spending, and material shortages pushing everything higher. Then comes another move from Beijing. In early March 2025, China quietly halts soybean import licenses for 3 major US exporters: CHS Incorporated, Louis Dreyfus, and EGT. The official explanation sounds harmless: logistical issues. But everyone knows it's political leverage ahead of a key tariff vote in Washington. The shock hits the American Midwest first. In Illinois, soybean prices crash below production cost, around $11.20 per bushel, according to the USDA. Equipment sales drop, fertilizer orders vanish, and small banks begin freezing credit to local farms. This isn't revenge. It's pressure by patience, what China's Ministry of Commerce calls rebalancing. The Financial Times interprets it more bluntly: a reminder that agricultural trade, just like rare earths, can be weaponized without firing a shot. Trump fires back with his usual confidence, saying on TV, "China needs us more than we need them." But the numbers tell a different story. In 2024, the US exported $143 billion worth of goods to China, while China sent $439 billion to the US. The dependence clearly runs one way. By mid-October, another blow lands. China's customs agency starts holding up magnet shipments bound for US defense firms. Reuters reports that suppliers were told to resubmit export paperwork, a bureaucratic phrase that really means weeks of waiting. Diplomats in Brussels read the move as deliberate ambiguity, China sticking to WTO rules while slowing the flow through red tape. It's a quiet chokehold with deniability built in. One late afternoon, Trump walks up to the press podium and says, "President Xi had a bad day. He doesn't want his country in depression, and neither do I." Markets take that as a peace signal, and the S&P 500 jumps 2% within hours. But behind the scenes, nothing changes. Beijing doesn't lift a single restriction. The National Security Council releases its usual statement: all options are on the table. Translation: there isn't one yet. Across the ocean, analysts in Shanghai notice the larger pattern. By tightening control on battery technology exports, China ensures that any Western company trying to build a factory abroad will still depend on Chinese engineers or patents. The French mining firm Aramat even tells Reuters that Beijing's new licensing system redirects value to partners who play by Chinese terms. Cooperation, but only on Beijing's schedule. Back in the US, automakers sound the alarm. GM warns that material shortages could disrupt its next generation of Ultium batteries. Tesla delays its Nevada plant expansion. Ford pauses a battery deal with China's CATL until export rules are clarified. Every decision traces back to Beijing's new export paperwork and the invisible power it holds. That evening, Treasury analysts finish crunching the numbers. Between electric vehicles, farming, and defense production, the combined disruptions could shave off % of America's GDP in 2025. around $120 billion if the pattern continues. The IMF's latest report calls it a trade-induced slowdown. Minutes later, Trump takes to Twitter. We're winning. China's struggling more. But the data says otherwise. China's industrial output in September jumped 6.3% year-over-year. U.S. manufacturing, meanwhile, fell 1.7%, according to the Federal Reserve's G17 report. Beijing's pain is theoretical. Washington's is real. As the cameras stay pointed at the White House podium, the true story is unfolding elsewhere. In cargo records, delayed shipments, and unpaid farm loans, China hasn't just stopped exports. It's exposed the myth of American self-reliance. And as midnight nears, an aide quietly hands the president one final update from the Department of Energy. Projected U.S. battery independence by 2030. 0%. Thanks for watching. Don't forget to like, share, and subscribe. And check out the next video already up on the channel.